Hey everybody, Jason here. You're watching Bolt to the Bust. Appreciate you joining in today. Some pretty shocking news, and this is Chase Bank basically eliminating all the credit card debt throughout Canada. So, of course, the holders of these cards that had balances obviously are very excited and great news for them. But it's also raised a lot of questions. Why would a credit card company, a major bank like Chase, why would they make that decision? And what's so rare about this type of occurrence. So we're going to get into that. First of all, just a quick thank you to all of my subscribers and viewers and supporters, including Patreons, and everyone that sent a little help through PayPal. So getting us to 31,000. Thank you very much for that. All right, so here's the story. Customers using Amazon Rewards, Visa, and Marriott Rewards Premier Visa in Canada were excited to find that their debt had been wiped clean, and it overall amounted in the millions and millions of dollars for Canadians. Now, when companies in the past have chosen to leave certain markets or close down one of their lines of business, typically they sell it off to a different bank or different institution. In this case, that did not happen. For example, HSBC pulled out of the U.S. credit card market, and therefore they went ahead and sold all those accounts to Capital One. So Capital One basically took over those accounts and proceeded then as normal. But in this case, that wasn't done. It was a clean wipeout of the debt. Now, on the flip side of that, you have other people that did pay off their balances in full every month who are, wishing they didn't do that and wishing they would have just ran up a bunch of debt, only to have it discharged and it doesn't show up as a negative on their credit report. So, and we see the same types of arguments made in the U.S. here, where they're talking about eliminating student loan debt. Well, think about being a student that worked hard, maybe two jobs or more, and sacrificed greatly to pay off your student loan debt, only to find out that some politician came in and wiped out student loan debt for everybody. So there's two sides to the coin there. There's a light and a dark side, so to speak. If you're getting your debt wiped out, that's great news. If you were a responsible person that paid your debt on every month or paid it off in full, then you might feel cheated or feel that this was a very unfair decision. But Maria Martinez, the Vice President of Communications for Chase Card Services, said in a statement the following quote: Chase made a decision to exit the Canadian credit card market. As part of that exit, all credit card accounts were closed on or before March 2018. A further business decision was made to forgive all outstanding balances in order to complete the exit, unquote. So, because they're making this very vague on their reasons for exiting the Canadian market and eliminating all that debt, we have to come up with some logical conclusions here. So, one, when we look at the wording behind what Ms. Martinez said there, she said, in order to complete the exit. Now, that sounds like a deal had been made or had to be made, and it could be likely that Canada has some very strict consumer protection laws because when you're closing down accounts, even though you're eliminating the debt for those individuals, you're also cutting them off from their lines of credit. So maybe they had some consumer protection provisions that said, hey, if you're just going to close down a mass number of credit lines, you need to eliminate that debt. So that could be one. Or two, maybe Chase saw some dire warnings on the horizon as far as household debt. So let's get into it here by looking at a chart here out of wolfstreet.com. And we've spoken previously here on the magnitude of the housing bubble in Canada. So Canadians, they've seen a big rise in their home prices and rises in the cost of living. And what happens when you see rising cost of living and inflation? You usually see debt increase pretty significantly, and it's very true. And when you look at compared to the U.S. here, and this is a chart that looks at U.S. versus Canadian debt burden, debt to disposable income ratio. So we know that stagnant wages and rising costs have more and more people swiping their credit cards. But when you look at the U.S. versus Canada, we see just an extraordinary run up of debt versus the Canadian people's disposable income. So another part of that decision for Chase to pull out of Canada could have been they were looking into the future and they said, hey, the future write-offs and possible bankruptcies and the future losses that we may sustain if we stay in the market, stay in Canada, could be much worse than just cutting our losses and getting out of it now. So it could be a combination of those two things that we talked about as far as the consumer protectionism and the business decision to cut their losses if they see future losses that could be even higher. So we don't really know at this point. I did check several news reports on this and several sources. So if you found out anything deeper beyond this, please let me know down in the comments. But this is what we found out. But I also want to add to this report some other recent news that bankruptcies are now rising across the U.S. So even though our debt burden, just like in that last chart we looked at, our debt burden compared to our disposable income is not as drastic as Canada, bankruptcy filings are now rising and it could get worse. And this is the wording that's put out here by this report. And we will link to all these articles, by the way. Now, at this point, bankruptcies are well below financial crisis levels, but they had decreased for many, many years, just like foreclosures decrease year over year for many years. And when you start seeing increases year over year, like we are now in bankruptcies, that could be another warning sign that you might want to pay attention to. And typically, what happens when you start seeing job losses increase and bankruptcies increase is foreclosure being the next in line because one of the things that can help people stay out of bankruptcy is borrowing against their homes. Now, we also have not seen that at the same levels yet that we did prior to the financial crisis, but we do know these economic cycles have limits. And yes, they are extending it out with central bank intervention, but signs are still emerging that we are possibly nearing a turning point, right? So, American household debt is about $14 trillion now. That includes mortgages, student loans, credit cards, and all debts, including car loans. So, we're already a trillion beyond where we were at the peak of the Great Recession or prior to the Great Recession. Now, the US, like Canada, had kept interest rates very low for an extended period of time. And one of the ways to fuel the rise in debt and spending and borrowing. So we look at the chart here and we see ever since the financial crisis, pretty low rates there. And similar to the US, had started increasing the rates in 2016, 2017. So different countries, but you can see similar patterns, similar trends. And the good news is we do have a way to completely eliminate all debt here in the United States, including credit card debt. Well, not including student loan debt, unfortunately, but eliminating debt here in the U.S. It's called Chapter 7 bankruptcy, and those are rising. And we'll see where it leads. Will the central bank go negative on these interest rates to keep this bubble going long enough? We'll just have to see. But thanks for watching. Let me know what you think about this down in comments. So thank you very much for watching, and bye for now.